Hey everyone, welcome back to Corporate Decoder, the place where we break down the boring to reveal the truly bizarre. Today we're diving into StepStone Group's proxy statement for their upcoming annual meeting, and let me tell you, it's a masterclass in corporate navigating. So what's the big deal with this filing? Well, it's essentially the company laying out its agenda for its annual shareholder meeting, which is happening on September 9th. Think of it as the company's annual performance review, but with a lot more legal jargon. They're asking shareholders to approve a bunch of things, including electing directors, okaying their auditor. The real juicy stuff often lies in how they explain their executive pay and management structure. First off, let's talk about control. StepStone is currently a controlled company because a specific group of Class B stockholders holds a majority of the voting power. This is because each Class B share has 5 votes, giving them a huge chunk of power. But here's the catch. This control is set to automatically end on September 18th of this year. This is a pretty big deal because it means they'll have to start following more of the standard Nasdaq rules for companies that aren't controlled. They're already making moves to comply, like planning to have more independent directors and making sure certain committees are made up of independent folks. This is a subtle but important shift in how the company will be run, and it's all laid out here. Looking at the board, Monty Brem is the chairman, but he's also acting as an executive advisor to the company. Then you have Scott Hart, the CEO. These are the key players making the big decisions. We see a mix of folks with deep industry knowledge and others with broad financial and operational experience. For instance, Valerie Brown brings a wealth of experience in financial services, and David Hoffmeister has a strong finance background and served as CFO for a major biotech company. Thomas Keck, another partner, leads their research and portfolio management. It's a board packed with experience, but with the controlled company status ending, we'll see how that changes. Now let's get to the part everyone's curious about: pay. Specifically, let's look at how the non-officer directors are compensated. For fiscal 2025, independent directors were eligible for a hefty $175,000 retainer, which will go up to $200,000 after this meeting. Half of that is paid in restricted stock units, more commonly known as RSUs, and the other half can be taken as cash or more RSUs. The audit committee chair gets an extra $25,000 as well, also split between cash and RSUs. It's clear they're aligning director pay with company performance through equity. However, you'll notice that for some individuals like Monty Brem and Thomas Keck here, their compensation is listed very differently. This is because they are partners or retired partners of the company and not eligible for the standard director pay. For Mr. Brem, his earnings of over $2.7 million in fiscal $25,000 retainer, which will go up to $200,000 fees and carried interest allocations, which is a share of the profits from the company's investment funds. Thomas Keck pulls in over $4.2 million, with a large chunk coming from. Let's dive into the summary compensation table for the top executives, the named executive officers or NEOs. For fiscal 2025, Scott Hart, the CEO, earned a total compensation of just over $4.7 million. This includes his base salary of $500,000, a cash bonus of $70,37, of stock awards valued at $45,000, $50,000, and $23. But the big number here, over $3 million, comes from carried interest and incentive fee payments. This is where we see the direct link between their pay and the company's success in managing vast investments of $37,500 and a significant chunk of stock awards valued at $400,000, a cash bonus of $70,37, $23. But the big number here, over $3 million respectively, with similar breakdowns at $27 incentive fee payments. This is where we see the direct link between their pay and the company's success in managing vast investment fund of $100 and a significant chunk of stock awards valued at $450,000, $27. A substantial portion of their compensation is tied to performance, which is a good sign for shareholder alignment. Now, how does this pay stack up against the company's performance? The pay versus performance table tries to answer this. It compares compensation actually paid to executives in financial metrics like net income and fee-related earnings, or FREE for short. For Scott Hart, his compensation actually paid in 2025 was around $55 million. This is higher than his reported total compensation because it includes the year-end value of outstanding equity awards. The table shows that while net income has been pretty volatile, dipping into negative territory in 2023, their fee-related earnings have shown a more consistent, albeit slower, growth. For example, fee-related earnings were $314 million in 2024. This metric for us seems to be a key driver, dipping into negative territory in 2023. Their fee-related earnings have shown a more consistent, albeit slower, growth. For example, fee-related earnings were 3 for 12 for Landell, $1.5 million. This is higher than his reported total compensation because it includes growth for Diplomated ups and downs. Their ability Let's quickly look at the fees paid to their auditor, Ernst & Young. For fiscal 2025, the company paid them about $5.5 million for audit-related and tax services. Importantly, the StepStone funds, which are managed by the company, paid Ernst & Young a hefty $30 million. This shows the scale of their operations and the significant role the auditor plays across the entire group. Moving on to some housekeeping items, Proposal 4 is about limiting the liability of certain key officers, like the CEO, CFO, and others, for monetary damages in specific situations related to breaches of fiduciary duty. This is a common practice allowed by Delaware law to protect executives. Essentially, they're saying that if an officer makes a mistake in good faith, they won't be personally sued for money unless it was a breach of loyalty or intentional wrongdoing. They are also proposing in Proposal 5 to clean up their company charter by removing outdated provisions related to their previous controlled company status and other things that are no longer relevant. As a reminder, the election of directors is up for vote. All 9 nominees are up for a 1-year term. The key takeaway here is that the plurality of votes cast wins, meaning the top 9 vote getters are in. Looking at beneficial ownership, these top execs and directors collectively hold about 33.9% of the company's total voting power through their Class A and Class B shares. While no single executive is a huge holder individually, combined they represent a significant voting bloc. You also see some major institutional investors like BlackRock and Vanguard are major Class A shareholders. What's interesting is how many of these executives have Class B shares, which means they have that much more voting power. Jose Fernandez, for example, holds over 12% of the voting power. So my take on StepStone? They're a company where executive compensation is heavily tied to performance, especially through carried interest and equity awards. This naturally aligns them with shareholders. The shift away from being a controlled company is a significant governance change to watch, potentially bringing more independent oversight. Financially, their fee-related earnings are a solid indicator of their core business strength, even if net income can be jumpy. The fact that certain officers are seeking expanded liability protection is standard, but it's worth noting how the board is trying to balance executive incentives with accountability. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.